Hello everyone, this video is a shout out to all the investors out there. Today we'll be understanding the concept of volatility in stock markets. So the very nature of stock markets is volatility, and this is the pain an investor must face to get that extra return over and above debt instruments like bonds or fixed deposits. Let's explain this. So अगर stock markets कभी नीचे आते ही नहीं तो everyone would be investing here only except debt instruments. Everyone would be investing here, so the prices would go up, the earning would potentially stay the same, so we would be paying a higher price and getting a lower return. This would mean that if everyone would be investing in stock markets and stock markets would be safe, then stock markets would be giving us approximately same return as compared to any other debt instruments like fixed deposits, bonds or anything. So how is volatility good? For the investor, it is the best thing that could happen. I'll explain. So as volatility increases, the general likelihood of people investing in stock markets would decrease, right? Because the uncertain factor, and this uncertain factor would lead to a higher risk premium, which would lead to a higher long-term returns for us investors. And historically we've seen that the correction in stock markets are temporary while the rises are pretty much permanent. So the market goes in this fashion: it goes up 2 steps, comes down by 1 step, goes up 2 steps, comes down by 1 step. So we've seen that Sensex has gone from 100 points from 1979 to about 38,000 points in 2018. But the ride wasn't smooth at all. It was full of volatilities. So if you have money and you can spare it for at least 5 years, volatility is your best friend. The second point is that volatility gives you great opportunities to buy at cheaper prices. So do not be sad that there's volatility, you can't invest. In fact, be happy that market is giving you another opportunity to buy the same shares at a cheaper price. Let's say you're an investor and the market is now correcting quite badly. What to do? If you're a regular investor, simply invest more. This is a great opportunity. If you've already invested whatever you could have, I recommend to go for a movie, take a holiday. Just stay away from these three, which is media, broker calls and analysts. There is only one thing in common between all these three, and that they always get proven wrong. So buy the right shares, sit tight and with patience. These news channels, I think, change their opinion every week. So I'll tell you my personal experience, what I personally saw. So once market was doing really well, that week market was doing extremely well, so all the analysts came up and they were praising India, that how big is the population, now we're actually taking advantage of the population, the young population, government bills, GST, e-way bills, and the list goes on. The other week market started crashing down and the same analysts were criticizing. Crude oil is going up, rupee is depreciating, unstable politics. They come up with these slogans like Dalal Street ban gayi halal street. I don't know how the fundamentals of a country, of an economy can change after a week or so. The main takeaway from this video is that there are no free lunches in life. So if you're getting a 17% return in stock markets, there is a reason behind it. The biggest reason is volatility. But for a long-term investor, volatility technically doesn't affect us, right? Why? Because we're buying right now and selling after 6, 7 years, 10 years, whatever. But the stock market will reward us for our patience, and it will reward us handsomely. So like the video if you liked it, dislike if you disliked it, and please subscribe to our channel. We post regular stock markets and financial literacy videos, and I will see you in the next one.